Sorry, my bad. You know how to do that. All right. I was reading stuff. Let me start over. David Chapinda. I'm so bad at this. This is why I need a guy. I need a guy or a girl, something. I need somebody to do this. David Chapinda said, good people, Jesse, you helped me to change my mentality. Thank you. He said, I believe that in life, when you meet someone that achieves the goals you want for you, you can't be jealous. You have to be the student, learn, and then conquer your own goals. I'm in debt to you. I 100% agree with that mentality. And Mike Lauk said too, I'm in the same boat, man. Jesse's taught me. So I'm happy to teach you guys. I think we should all be students. And I think it's very odd. It's a very communistic, socialist idea to look at people that are successful and hate them. It's just a really horrible way to look at life. If people are successful and they've done what you want to do or what you aspire to do, or you find what they do fascinating and just again inspiring, you should be trying to emulate them. You should be encouraged by what they can do. You should be able to try to find out why. That's the meritocracy, democratic, capitalistic way of looking at life. And I'm so glad we've elected the people we have into power, because that is the way we should be looking at things. We shouldn't be jealous of other people's success. I think that's so fucking stupid. You need to compare yourself to yourself. The only person I'm ever going to be jealous over is me. Okay. And then the great thing about that is if I have jealousy about how great I've done, I'll be like, oh shit, that's me. I'm okay. But so right now on CNBC, they're talking about treasuries and what's going to happen with the yields and about how those will be a guide for what's happening with Powell. We're going to look up the Fed rate decision in a second. I do agree with what he said. Also, Bitcoin appears to be outperforming right now heading into this. We're going to pull that ticker up and plop it into the bottom corner over here. So we'll be doing that in a second too. I've just got to clean it up, line it up, make it look a little bit better. But we're going to unmute here, and I'm going to start getting stuff ready. But the decision should come out in 6.5 minutes.
Sanders and Alexandria Ocasio-Cortez proposed. That's not something a president can do unilaterally. I don't really see any movement on that. There would actually be major unintended consequences.
Like, such as?
Access to credit, other fees could go up. It just wouldn't be profitable for banks if that's all that they could lend at.
We have buy now, pay later, Ted. We don't need the credit cards anymore. I'm sure that's what that industry would say.
It is creeping in a little bit. It's still, though, somewhere between 1% and 3% of the overall credit card market. So it's growing rapidly, but it's still a small slice. Credit cards are still huge business. I mean, there's over $1.1 trillion of outstanding credit card loans.
It's a big number. Ted, real pleasure to check in with you before this decision. Thanks for your time.
Thank you.
Ted Rossman at Bankrate. That's it for us. The Fed's decision on rates is moments away. Tyler is gearing up for that, and I'll join him on the other side of this break. Stay with us.
All right, we're breaking out here. I'm actually going to go back. I want to hear what he was saying, especially about Ocasio-Cortez. 1 second here.
Today hard. They are back on the rebound today in advance of the Fed. A 25 basis point rate cut is
lower. Some of them have even gone up despite that 50 basis point rate cut from the Fed on September 18th. My next guest thinks these rates should continue to fall, but only like a feather. Ted Rossman is senior industry analyst at Bankrate. Ted, it's good to have you here.
Good to be here.
So they cut by another, let's say, 25 today. Consumers and shoppers, I mean, they shouldn't really expect any near-term relief.
That's right, especially for things like credit cards where the average is still over 20%. I mean, really the advice there is get a 0% balance transfer card, work with a reputable nonprofit credit counselor, do what you can to pay it down. Credit card rates are high, they're going to stay high. Car loans too. I mean, we're talking mid-7s for new cars, low 8s for used cars. I mean, these are much higher than we saw a few years ago, and we're not going back to 4% anytime soon.
Should the providers be blamed for these high spreads, or are these high spreads a function of high, or let me put it this way, have the spreads gone up or not?
There's been a little bit of margin padding, especially on credit cards. You know, one factor is actually the CFPB's proposed late fee cap. And that's actually led some issuers, especially store cards and subprime cards, to pad that margin, basically compensating for a drop in one place and maybe make it up elsewhere. Also, we have to remember the Fed pushed rates higher by 5.25 points, and it's going to take a while to unwind that. I mean, we're talking the highest rates in decades for many of these products.
But in reality, if they had cut by 0.5 point 6 weeks ago, and we saw that 0.5 point play out across the curve, these rates would start to be significantly lower. It's this unanticipated sort of rise in long-term rates as a result that is why we're looking at a relatively unchanged picture today.
Especially for mortgage rates, yeah. So there was a little bit of buy the rumor, sell the news, I think, that was going on here. A year ago, mortgage rates briefly hit 8% for the first time since 2000. And then they went down to 6.2,
totally,
and now they're back to 7. Also, the Trump re-election is part of this. Perhaps higher rates needed to combat some other factors that could be inflationary, like tariffs and lower immigration. But, it's going to be interesting to see where mortgage rates go from here. I expect that's going to be a big topic during Powell's press conference.
That's good.
Maybe not mortgage specifically, but more about where is that terminal rate? Like, where's the long-term neutral? It may not be as low as we thought. The other part is that economic data has come in more solid than expected in many respects. So, maybe we're not going back to a 2.5% Fed funds rate. Maybe it's eventually 3.5. That's going to keep all these rates higher.
Exactly. I mean, it's a sort of a grisly joke to make, but if they wanted these rates that we're showing to come down, maybe they should be hiking the overnight rate. In other words, if people were worried that would slow the economy and certainly put downward pressure on inflation, yes, it would invert the curve, again,
and whatnot.
But I mean, for instance, if they hiked by a full point, you'd probably see the 10-year fall. You'd probably see some of those rates go down as well.
There's also a little bit of be careful what you wish for, though. For instance, like for mortgage rates to get back to the 4s, there would probably have to be some really bad economic news.
Exactly.
So, it's a case where you're not going to want to buy a house if things are crumbling. So, we are thankful for the stronger tone of economic data, but it's tough for borrowers. I mean, it's one of these all news is local kind of things.
Sure.
If you have credit card debt, it's been a tough environment. If you're a first-time home buyer, it's a tough environment.
On that example,
if you have credit card debt that's 20 to 30% and you're not paying that shit off every month, you're in the wrong fucking YouTube channel. You need to go somewhere else and figure out how to pay your debt off, because that's crazy. Look at Bitcoin, guys, 76.8 almost right now. We're setting new all-time highs while we're waiting here, guys. I'm gonna fast forward. He made some good points, but we're going to fast forward and get ready here. Did you say you bought TLT with Tesla proceeds? I did, yeah. I'm just gathering cash. It's a very small amount. It's like I shifted 0.3% of my portfolio today, guys, maybe less.
May dictate to some extent the direction of monetary policy.
So
Stephanie, do you agree with what David just said? In other words, a quarter-point cut, and maybe as we head into next year, an intense focus on the Fed's part on what's going on fiscally. In other words, with tax cuts and spending.
Yeah, I mean, Powell's not going to want to make any predictions about what fiscal policy is going to do, so they're going to stick to data as they come. Very likely they're cutting 25 this time. Our base case is they'll probably cut 25 again, and then they'll move to an every other meeting type of cadence.
She's cute, she's young, and she's talking investing. Gotta love it.
Case, they'll probably just continue at that type of trajectory until they get real clarity on fiscal policy, meaning it actually getting implemented.
All right, Jim Caron, we got about 45 seconds or so. What's your thought?
Oh, yeah, Trump getting
elected. Look, I think 25 basis points, like everyone else is saying. Look, the Fed doesn't get paid to speculate on fiscal policy. When the policy's there, they will evaluate it. They'll see what the impact is on the overall economy.
21 seconds, guys.
The key question here today is that they set back in September the terminal policy rate somewhere around 3%. The market thinks it's more closely aligned with 3.5%. That's one of the things that pushed yields higher. So the question for me...
I'll refresh here. I want to make sure I'm current. All right, guys. Still looking... Argentina, it says, is printing. Oh, they're doing their industrial production number, too. I can't wait for that. Still waiting on the Fed rate decision. Builders in Houston have been offering mortgages in the 3 for a while. Yeah, they're paying. Yeah, they're basically offering lower rates. 100.
Rate might be. Let's get to Steve Liesman for the Fed's decision.
The Federal Reserve cutting interest rates by 0.25% to a new range of 4.5 to 4.75%.
All right, there we go. They did
a range of 4.625. The decision this time was unanimous.
25 bips,
there
guys.
was no dissent by Michelle Bowman, the Fed governor.
No dissent.
The committee will continue, it says, to consider adjusting the funds rate, looking at the data, looking at the risks and the outlook as well. It sees risks on both sides of its mandate. That is the possibility of higher inflation or higher unemployment.
Total 3 broke out. I believe it. Shitcoins are going first.
balanced, it says.
Ethereum?
The economy is expanding at a solid pace, same language as last time. Labor market conditions have generally eased. Before, in the prior statement, they said that labor market conditions have slowed.
Look at the day today for Ethereum and Solana.
Better number or characterization than it had been. Inflation, it says, has made progress towards the 2% target, but it remains elevated. It removed the line that the committee has gained greater confidence inflation is moving towards 2%. I don't know what that means or how to do that. It says instead it's cutting in light of support of its goals.
Ethereum's up 7.7%. I told you it could outperform over the short term.
Finally, it says the economic outlook is uncertain, but it will continue reducing its balance sheet. Kelly, that is it. I would say a waveless or splashless.
We're going to look at crypto for the hour.
Post-election
here, guys, see where it's going.
Well, it's a bit early, but you're probably right. Steve, stick around. Let's turn to our panel for some more reaction. And, of course, to look ahead to the press conference that is coming at 5:30. And, Jim, that's often when we've seen some bigger moves.
So it is.
Yeah,
Look, I mean, ultimately, I think what the Fed is going to try to key off of is what's happening in the labor market. I think inflation they're comfortable with. Inflation has been coming down. It's starting to settle down. They're making progress to their 2% target. I think that's yesterday's news. Tomorrow's news is what happens to payrolls. Now, look. Ultimately, we've had some storms. We've got a lot of noise within the data. This is stuff that they have to sift through. But I think their biggest concern is if there is a slowdown in the economy and if the unemployment rate starts to rise very, very quickly, then they will have wished that they've continued on with their pace to cut interest rates. And I think that's what they're going to do. 25 today, 25 in December, and I think they're on a mission to 4%, and then they're going to reevaluate.
The statement admitted the reference to having gained greater confidence in inflation moving sustainably to the 2% target. David, what does that mean?
I don't think it means that much. They're always trying to use as few words as possible, so if they can get in a sentence, they're happy to do so. I think
it's really all about what
use that language
now, guys.
while justifying a first move, but I don't really think it means very much.
Why do you guys think
I feel
finances
pretty good about
are down
payrolls,
today?
though. I think that after the election,
is it just lower rates?
Just not seeing commercials will make people feel better. But I think you will see a bounce in small business confidence. There's a lot of uncertainty going into the election.
Alejandro,
I think people will probably be more positive about making business decisions. So I don't see any reason to expect a slowdown. We might actually see slightly higher inflation in the months ahead. So I don't expect the Fed to accelerate the pace of rate cuts.
Stephanie, your thoughts?
Yes.
Let me. I want to say this real quick. Keep playing that. Oh, it's Stephanie. We're going to wait for her. All right. Airbus, Hyundai, Goldman Sachs, many other clients among partners still don't convince you. There's nothing more I can do. We've been talking about Ionic since the stock was 7 on your channel. I'm happy for those. Yeah, that's great. What are the contracts for? Are these just them investing in a smaller company like they do with 100 other companies? Or are they of substance? I gotta know more, Alejandro. I gotta know more. Just having contracts doesn't mean anything. In the crypto world, people talk about contracts with big companies all the time, or they use the term partnerships, right? But the partnerships aren't shit. They have them with Google Cloud, they have them with Azure, they have them with AWS, and the partnerships are like, hey, we clicked a couple things on a portal and we became partners. I need to know what actually is going to turn the company into something amazing.
That every other meeting cutting cycle from here. The one thing we didn't talk yet about is the ECI. The Employment Cost Index showed wage inflation just continuing to slow down. So this is largely explained by perhaps productivity picking up, which is a great backdrop for the Fed to be able to continue easing, even though the economy is holding up fairly well. We're sitting here in a kind of a non-inflationary type of growth environment with productivity actually picking up. So despite the expectation that growth is going to remain fairly solid here, the Fed is still able to continue its path on easing.
Agreed.
Steve, we turn to you for some more
totally
color from the statement. Were there any dissenters?
We like her.
No, not this time. There was some speculation, at least I guess it was from me. I was thinking that maybe Michelle Bowman, who was unhappy with 50, would be unhappy going a further 25, which would be 75. She'd want to be 25, but I guess she's on board now. Sometimes, Kelly, when a person dissents, they dissent the one time, they let their objections be known, and then they go along with the committee in the future. I've seen that quite a bit. The idea that, hey, you raise your hand, you let me know.
Let's look at
Ionic. I like the characterization that was said earlier, and I think it's worth thinking about. The Fed says in its statement that the risks are roughly balanced. But what's it doing?
Look at that burn.
It's cutting rates. So it is indeed acting, regardless of what it's saying about the risk being balanced, it's acting as if its bigger concern is indeed what's happening in the employment market. And it's going to be interesting to see, well, first of all, about revisions, but maybe how the Fed chair or other Fed officials characterize that recent October report we got, which was indeed, messed up by the hurricanes and by the strikes. But still, when you look through it, and I talked to a lot of economists about this, generally they saw it as weaker. Because if you add back 100,000 from those two factors, you still have a pretty weak employment report. So I think the Fed is saying risks are balanced, and that's part of this whole
Bitcoin coming back a little bit here.
Maybe one of the questions we might ask Fed Chair Powell, hey, are you recalibrating or are you done recalibrating? Because the recalibration is kind of like, we need to get down to another place, and then we can start thinking about acting more along the lines of the data.
I'm actually... Kelly, does a new administration mean anything to the Fed or to the Fed chairman? Obviously, Mr. Trump is known for being outspoken, for saying exactly what's on his mind. So talk to me about that a little bit.
Yeah, not yet, I think. I think that the Fed will continue to cut gradually. The first, in December, I think they'll cut again, and then we'll go into early next year, and we'll see what policies are actually likely to make it through Congress, and whether there's any early action on tariffs. That could have a big implication, because if you have a big increase in tariffs right off the bat, that's going to increase inflation. That might make the Fed more nervous.
I'd love to be
but I think the Fed is going to try and keep its head low for a while and see if it can avoid getting any incoming from the new administration. Eventually, though, if something goes wrong with the economy, I expect that the administration will get very mad with the Fed and blame the Fed for that. But that's kind of comes with the job if you're on the Federal Reserve.
Jim, do you think, I believe the Fed chair's term continues into 2026. Do you see any possibility that he might not fill out that term, either because he decides to step away or because he's basically pushed?
Well, there's always a possibility, right? I don't see it, though. I don't place this as a very, very high component of potentially what President Trump's policies would be to remove the Fed chair. I don't think that's his first stake in the ground that he's going to make. I mean, like I said, it's clearly a possibility, but so far the Fed is doing pretty much what he wants the Fed to do. He wants them to cut interest rates. The Fed is in the process of doing that. That should hopefully stabilize and help the economy. Ultimately, the Fed has a dual mandate of price stability and full employment. I think the number one thing, whether it's President Trump or it's Chair Powell, is they need to make sure that the jobs market stays stable. Because if it doesn't, there's this thing called reflexivity. And what that means is that you can get a rise in the unemployment rate that comes very quickly, and that can have very negative effects on the economy. So I think what the Fed is really focused on right now is making sure that the labor market stays as stable and as healthy as possible, and doing rate cuts is doing their part to ensure that that happens.
Stephanie, what do you expect to be the impact of kind of what's been mentioned on the tariff front, at least?
Yeah, that's my concern, Fabio. Again, the financials don't tell me that this thing is anything major. And I could be wrong. The fundamentals could be good. There could be real relationships here for real reasons. That's possible. I've just been duped so many times by companies that were the next big thing that weren't really the next big thing. And the reason people talk about them is stock price go up. And I'm not a stock price go up investor. I'm just not. So if you guys want that fix, you can go to other places. If Bionic is real, I mean, I'll listen to the earnings call. I'll give it a chance. But if it's real, they need to start proving it in some of their financials. They need to actually have revenue. Why does this company only have $12.4 million in revenue? If they're real, and this isn't just speculation, they should be going up a lot, okay? Now, they do have estimates for increased revenue, but next quarter it's going down. It's only going to be 11. Then it's 16. Then it's 17. But if they're doing 17, does that mean they're burning 100 million? Because this cash flow is the worst fucking thing I've ever seen in my life.
Based on just the general inflationary stance under this Trump administration, because again, the previous one, for all the tariffs that were implemented, they were cutting rates by year 3 of his term.
Yeah, so one, we do think it's fairly stagflationary. When we modeled it, we look for about a 1% hit to GDP and a 1 percentage point boost to inflation. So this is very stagflationary. The thing is, it's not proper policy for them to be hiking rates as a result of the inflationary impact, because that would likely cause a real serious downturn in economic growth. So the proper policy would be more likely to just hold and watch and see how things shake out, rather than to act more hawkishly as a result. So base case, it is a negative impact. 1% hit to GDP is probably a conservative number. It could be much more significant depending on how this shakes out.
Although, David, the entire agenda seems to be one where they're trying to grow our way out of these myriad problems.
Well, yes, but I mean, there are a lot of promises made, and the really interesting question we're all going to be grappling with here is, once there's no campaign, there's no real pressure on President Trump, how does President Trump and a Republican Congress decide to move things forward in terms of policy? Because I don't think they're going to implement everything they promised.
Well, the pressure could come from the bond market, though, and that's why it's interesting to watch those levels taking a breather today.
Yep.
Yeah.
Go ahead, Steve.
I was just going to say, guys, I have a question for the panel, which I've never done before, okay? The question to ask Powell today is, what does he think about the recent rise in interest rates and what that should say about Fed policy? The answer Powell will typically give is, well,
Gunnar and Gracie feels the same way.
These things go up, they go down, we watch them, it's an input, but we
What
usually
is her full
look past
name? Stephanie
market
White.
movement. How do you ask the question in a way that doesn't get you the stock Powell answer?
Stalker, cyber stalker on X.
It's a jump ball. Who wants to take it?
I guess I'll start on this one. I guess the way that I would start that question is really asking about the deficit, right? You know, the way I would ask that question is how does Powell think about, how does the chairman actually think about the rising deficit, the potential to fund that, and what impact that might have on Treasury yields, and then how might they actually react to that? Now, clearly, higher rates will slow the economy, could actually slow inflation, so sometimes there's an adverse effect or an effect that's not necessarily accounted for.
All right. Thank you, Jim. Thank you, Jim. Thank you, Jim. We take fiscal policy as given. That's what Powell's going to say in response to that one.
Papa Powell.
Well, how about you ask him, does he think the increase in rates is due to higher inflation expectations, higher deficit expectations, or higher growth expectations?
And what
he won't want to answer it, but
what did you say, Steve? I didn't hear you, Steve.
I can work with that. I can work with that, David.
All right,
that's not a bad one.
All right, Stephanie, any final thoughts?
Stephanie.
Yeah, I think you can ask him how he's thinking about if rates stay above 4.5%. Is the market doing some of the work in the opposite direction of what they're trying to do, and how do they feel about that? Because right now the market is actually counteracting what the Fed is attempting to do here today with their cutting rates.
They keep asking me to partner.
It's been great being with you. Thanks a lot.
I don't
as always. Appreciate your time. Let's get to Bob Pisani now at the New York Stock Exchange. Bob.
And Tyler, not much reaction in the stock market. The S&P 500 is essentially unchanged from where it was just about 10 minutes ago, and probably for good reason. Here you look at these numbers, here are these comments. The growth is decent here. Economic activity continue to expand at a solid pace. Labor market conditions generally eased. Unemployment rate moved up but remains low. Inflation's made progress toward the committee's 2% objective, not far off from where it was at the last meeting here. I think the problem is that for this press conference, nobody down here thinks that this is going to be about inflation or the trajectory of growth. Everyone down here at least believes that this is going to be about tariffs, tax cuts, and whether Powell will stay on if President-elect Trump wants him to leave at this point. And of course, the tension is Powell has always refused to deal with these kinds of questions. He's always said, I'm happy in my job. I plan to stay on it until the end. And he's always very much stuck to the trajectory of economic data and avoided having discussions, theoretical discussions about things like tariffs. The problem from everybody's point of view at this point is the Fed's mandate partially is to address inflation concerns, and to the extent that something like tariffs might be inflationary, that could very much affect the Fed's trajectory, a growth trajectory for next year. So it's a legitimate question. I anticipate he'll be avoiding it, but I anticipate that there'll be a little tension here because the press will be constantly rephrasing that kind of question.
Yeah, whatever. S says, are you concerned about the housing market taking a hit? Shit, 30% of the workforce is immigrants. No, I'm actually, it's going to be the opposite of that. I don't know if I have, I always forget, new home sales, existing home sales, pending home sales year over year. Let's see, existing is probably a good metric here. Yeah, okay, it's pretty good, right? So if you look here, you'll see that existing home sales are horrific. These are horrific numbers. We're near levels that we were at the bottom of the 2008 Great Financial Crisis and near levels that we saw before that in 1995, 96, when I would have been graduating high school, if I would have graduated. So no, we're already in that zone. We're already in that zone, and we have too few houses. We actually have the opposite problem right now. So with rates lowering, if anything, I think you see existing home sales open up in inventory. They made up 80% historically, And what we'll see is a resurgence in the housing industry. So I would say housing actually is going to explode higher in the future, okay?
This magical yield that the Fed thinks that they're going to know about when it happens. It sounds a little bit like, fiscal and monetary voodoo to me. Other than the fact, if you look at the actual data points that we've had recently, the last jobs report had almost a 30% revision to
having rates going down is bullish. It's bullish because we have an economy that's kind of teetering. It's doing all right, actually. It's doing better than people expected, but there's a lot of government jobs. There's a lot of bullshit in it. But having rates getting lower, it means it's easing now. Well, I shouldn't even say easing because honestly, we're probably in constrictive territory with where rates are right now. Maybe another 25, 50 bips, it turns really into easing and not just tightening. But we want rates to come down at this stage, and that helps with global liquidity. And here's how it helps with global liquidity, and a lot of people don't seem to understand this. But when rates are coming down, you create more loans. Loans are fractional reserve. And so what that means is the bank could have 5% of the reserves for the money they loan you out. So they kind of create money in the form of a debt instrument. And then that money can go out and be spent. So lowering rates all around the world increases borrowing and increases money spending. So look at it that way.
August and September.
Now, that doesn't always have to be true. It could just be people trying to survive if the economy was shit, but ours is not.
Calls into question.
Yeah, Enphase has been hit a lot.
Accuracy. If you look at the personal consumption expenditure core year over year, 2.7, sticky. In terms of what the Fed's doing, it makes complete sense. They've telegraphed it. They've been in sync with the markets.
Yeah, I'm going to be buying ARGT, TLT, and probably ARCG.
Fiscal policy and what the Fed...
And maybe Micron too. Oh, let me go back here. I want to hear the last of what he had to say.
Number 4, so low, they definitely were part of the problem with respect to allowing the government to overspend.
Legit.
Because, heck,
that's
zero interest rates is not really costing us anything. That has changed. To find a sudden interest in fiscal policy now, I would scratch my head. We have no idea what the next president, Trump, number 47, is going to do. Much of the talk to get him elected
I have a lot of
many candidates are kind of presenting a bunch of issues and how he may move.
I have at least a couple hundred thousand. One thing for certain,
look for tax cuts. Another thing for certain, look for many in Congress to continue to not use dynamic hedging and get it all wrong in terms of what the problem is. It's not a revenue problem, it's a spending problem.
TLT,
that should
stock,
be one of the first
ARGT,
questions.
stock, MU,
Rick, thanks.
stock,
we appreciate it. Rick Santelli keeping an eye on things.
ARCG,
We're minutes away
options.
from Chair Powell's press conference. It starts at 5:30. We'll take you there live as soon as it happens. His comments can often be much more market moving. First, we'll get some more reaction to this 25 basis point cut from former Fed Vice Chair Roger Ferguson.
All right, let's go live
right back
again.
On Power Lunch.
Let's go live again. See where we land. Federal Reserve cuts interest rates by 1/4 point. Exciting. So exciting.
Well, first, thanks for having me on. Look, I think it's a combination of an expectation of increased deficits, perhaps growth staying strong.
Dude, this guy sounds so nerdy. It's awesome.
You have the Fed cutting rates as the fiscal policies are becoming more stimulative. And so I think the market is suggesting that the borrowing costs that the U.S. government is going to face are more likely to go up as opposed to going down as we go into a bout of what looks like pretty serious deficit spending.
So what is the Fed's role when that is
there's a reason.
The case? No one's saying that.
I'll mute this real quick. So, all right. So Human to Gunner and Gracie. Problem with refinancing, after the .5 cut, interest rates actually went up, so mortgage rates may not be reducing for some time. Not true. Untrue. So, yes, they went up. They went up because the bond market was rejecting the premise of the Fed lowering rates so aggressively because they're worried about inflation being a bigger concern. The bond market is supposed to be the smart money. They're wrong. Inflation is not going to be our concern. It could be in the future. If we really start taking off and our economy gets better, we could see some issues with inflation. But if we're lowering the size of government, we'll be taking away some of that. But that's not the concern. So the bond market is wrong. The smart money is wrong. And they will be forced They will be forced to realize this, and rates will come, or I should say yields in bonds, especially at longer end of the curve. And all that means is like think 10, 20, 30, right? But for years, they will be forced down, just like they're being forced down now. And as that happens, you will see mortgage interest rates come down. You'll see auto loans come down. You'll see all this stuff. It's just not happening right away because they're basically fighting the Fed. They shouldn't fight the Fed. The Fed is right.
Thing. And so I think
Alejandro can probably respond to that if he's here. I don't remember off the top of my head. I think it's usually 24 hours, but I'm not 100% sure. Don't quote me on it.
Out there. And so
I'm just going with TLT, Michael, because I'm afraid of applying a multiplier right now, especially a 3x multiplier to the bond market, because I think we could still tread sideways for a while. So I don't want to put something theta decay in there if I don't have to. I'd rather just hold the bond and then have potentially 50% upside. This is Jesse versus Druckenmiller. He's short. Yeah, see, so Druckenmiller is short, but we don't know if he's already exited that play. We don't know how long he's short. And I'm gathering TLT right now because I'm going to use it as a hedge in the future. Also, he went short before the election where Donald Trump won. And before Donald Trump with the Department of Government Efficiency was looking at actually lowering the size of government and reducing it and saving a bunch of money and lowering our interest on debts while rates are coming lower. So I love Druckenmiller. I think he probably had a really great play. He's probably done really well off of it, but you got to realize he could already be out of this trade. I don't know how quickly, what his reporting requirements are, or he could be getting ready to exit it. So you just have to keep that stuff in mind. We might be very close in what our consensus is, even though we're on opposite sides of the fence right now, okay? It's very important to understand that. Kyle Wright, Jesse, election result, have you thinking about pushing your home purchase earlier? I know you were thinking of fall. Yeah, so right now, honestly, I'm looking at late spring to early summer because I want to buy a home sooner. I'm thinking maybe close to $2 million. There's just one I really like with this indoor pool. I showed it one time on here. But, there's Meta Platforms. I'm sorry. I get excited. That's Dylan LeClaire's company, or like one of them that he's working with. But, yeah, so what were we talking about? House. So, yeah, I do want to start earlier because my fear is that the market opens up substantially and people start, like I should say this, it turns into seller's market because even though there's inventory going online, buyers are like, oh shit, I want to get my home right now at a low price. So I'm going to pick up that one I really wanted. And I'll get it. Like I should say this, I think inventories are going to open up first. That we'll see some prices dropping. We'll see more inventory. And that will create a market where people are like, ooh, fuck, I love that one house. Let's go get it. Let's buy it now. The price dropped a little bit. Rates are going to be coming down in the future. I'll buy it now and get ahead of these other guys. And I'll do that now because later on I can refinance it, kind of like I think Kyle was saying a little bit ago. And that's my mentality. That's what I'm thinking. I would rather, if there's a bunch of inventory that comes online, prices drop a little bit because there's more inventory, I'm going to start looking for the house I want at my dream home. And I'm going to buy it. And I'll buy it even at a higher interest rate, knowing that I'll be able to refinance it later. Because I do think the direction, even though it's going to be higher, it's the nominal rate for interest rates is going to be higher. It's going to be like in the 3.5 to 4 range. So people have to expect they're not going to get a 2.75 on a house in the future. They'll be lucky to get 4.25 or 4. Okay, unless there's some kind of buy downs or something. But yeah, it's going to be interesting. It's going to be awesome. Doesn't TLT run into theta? No, it's just the 20-year bond. TMF does. TMF is a 3x leverage play on TLT. Gunnar and Gracie, yeah, I assume he already exited a bunch of his position. That's my assumption. Hey, Palantir 3030's here. Love you, Adam. Why TLT? 20-year going down? No, it has been, and it won't be, though, because here's my thesis. So I believe in the future, now that Trump is in office, or will be in office, and that Elon Musk is going to be heading Doge along with the head of Cantor Fitzgerald and Ron Paul and some others. They're going to make it where people start to have faith in the government and our ability to repay our bonds in the future. When people believe that we're going to be able to repay our bonds in the future because we're embracing Bitcoin, we're creating a reserve, we're listening to Jason Lowery about Bitcoin being a strategic asset, not just for finances, but for truth and almost a new war that's not kinetic and not using other weapons, but is control of the hash rate of the Bitcoin network. If we start embracing that and we do what Cynthia Loomis talks about, and we start trying to get to 1 million Bitcoin in holdings, and we encourage miners to come in and mine Bitcoin, and we're reducing the cost of government and all this stuff, it's going to be incredibly helpful for the long-term bonds, because people will go, oh shit, is America great again? Can I actually trust a 20-year, 30-year bond? And that'll be huge, and it will help. And then we'll see this thing go up. And the reason I love this so much is we're looking at routes, and some of the bond market, the route was so bad that the bond market lost the most it had ever lost since the 1700s. So you got to realize all these older people that were in the 60-40 portfolio got utterly fucking destroyed. But that's an opportunity for us going forward if our government creates a more sustainable path for their future. So that's kind of the thesis there. And I said if Kamala got elected, I wouldn't even be looking at TLT, but she didn't. So I'm happy. All right, here we go, guys.
Welcome back to Power Lunch, everybody. Just minutes away now from Fed Chair Powell's press conference at 5:30. For a little more analysis, let's bring in Mike Santoli for some perspective. Mike, what do you make here? I mean, Kelly and I were just joking a little bit. We've gone from maybe the most consequential presidential election to the most inconsequential Fed meeting we've seen in years.
Inconsequential, that's true.
For sure,
yeah, that's
Tyler,
true.
and in fact, I'm sure that's the way Chair Powell probably likes it. Kind of a low drama decision,
a low bar, Powell.
The statement barely tweaked. And really,
I did watch The View. It was funny as shit.
The fact that the Fed and policy are in a pretty comfortable spot for now.
To be clear, guys, Republicans won the election, according to The View, because all the black, Hispanic, and white men are misogynists who hate women. And what were the other excuses? I don't know. Just a bunch of stupid shit. So it's really our fault, guys, for hating women so much. I don't know about you guys. I kind of like women, personally. I have no problem with women. I would elect a brilliant woman as the president of the United States. If we had like a Tulsi Gabbard running for president, I would elect her. She's a badass, dude. But yeah, I don't know. Do I care about Kamala Harris? No, she's a fucking idiot. She's a moron. Oh yeah, no, I watched it just to hear the response. I wanted to see the meltdowns. There's a bunch of good meltdowns out there, guys. Bunch of really good ones. Yeah, Tulsi, I watched a video of Tulsi on The View, basically calling out all the bitches on it for everything they'd said. She was so great. You could just tell they were foaming at the mouth. They hated her so much. It's good stuff. I don't get it's not even just class warfare. It's like class warfare, sex warfare, race warfare. It's all this stuff. And it's like, guys, the working class voted you the fuck out. So you can try and use this, but it ain't working. They literally said, we hate your fucking ideas. We're tired of you pushing this shit down our throat. Bye. So, and if you're just going to shit on people like Tulsi Gabbard, if you're going to shit on Robert Kennedy, if you're going to shit on Shanahan, anybody who does, and why did they shit on Tulsi Gabbard? Because she went on Fox News and other right-wing sites like Tucker Carlson to talk to these people about her views. And that's unacceptable. You can only talk to left-leaning traditional media. And it's like, well, then you lose these people. And when you lose them, you should reevaluate why you sucked so fucking bad in this election. But are they going to do that? No, they're just going to call us racist and misogynists. Because she was black. She's not black. And then at the same time, she's a woman. We're making that assumption. I don't know. Can we even know that she's a woman in the Democratic Party? Is that possible? I didn't think that was a plausible thing anymore. Yeah, female, race, rich, poor. It's like, it's just trying to separate people and divide them, and I fucking hate that. There are so many different people in this chat right now. We got people from Russia, people from Ukraine, people that are Jewish, people that are Arabic, people that are from all over the world in this chat, and we all work together to try and help our financial futures and the people we love. That's the way it should be. It shouldn't fucking matter what color of skin you are, or whether you're a woman or a man, or have a dick and think you're a woman, or whatever the fuck you are. I don't care. It's really that simple. Isn't this the funnest pre-Fed discussion ever? Oh, here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures.
Agreed.
Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer-run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate.
What is it, Zoroastrian?
At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
That was quick.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be
Bond
to
yields
changes
are
in
dropping.
economic policies
That's
with
good.
the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timros from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%,
2 years dropping
higher
hard.
borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
Yeah, 10-year. Yep.
So I would just say this: we've watched the
I've got that up right now.
Run up in bond rates,
it's down
and
2% today.
It's nowhere near where it was, of course, a year ago. I guess the long bond rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle.
Just treat TLT as cash.
Ultimately,
that could make you money.
I'm sure we've all read these decompositions of what and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. Cool. We do take financial conditions into account if they're persistent and if they're material. Then we'll certainly take them into account in our policy. But I would say we're not at that stage right now, which is something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now?
You get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. People are. Let's talk about the data we've gotten since the last meeting. So, in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger.
2 year too.
Certainly, the September employment report was stronger. The October report not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and we'll make a decision as we get to December.
That's getting the people that.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell.
Which is fine.
When it comes to December, what will you be looking at specifically as you try to make that decision? And then, as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you
Powell's
give a
drawing
little
down the markets.
detail as to why?
I can't. We don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December we're going to be again. At every meeting, we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points, and we're asking ourselves, is that where we need to be? That we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are.
About inflation.
But that's the question we're going to be asking in September and in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, we're going to wait and see how things come in December.
It's probably too much.
It's just
maybe.
I would put it this way: we're on a path to a more neutral stance, and that's very much what we're on. That has not changed at all since September.
Oh, good.
We're just going to have to see where the data lead us. We have a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but I would say I would say that again, we didn't update the SEP, so I'm not going to characterize where the committee would be.
Howard.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress, and in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation?
Doesn't look like the funnest group of people
to party with. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then
no panic.
It's
really,
new forward guidance. It's brand new forward guidance. What do you mean?
It's pretty flat.
Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about.
That's good.
It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. There's a fair amount of uncertainty in that. In what I've said, the path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go, And I think there's a fair amount of uncertainty about that, and you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Liesman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates, and are rising deficits a concern to you?
They're always a concern.
So we don't comment on fiscal policy, and again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outline, so we'd start to model it. And then we'd wait, and then at a certain point, the staff would brief the FOMC and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that, and then the law actually passes. And you'd start to put it. You'd probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So, we have a very large economy. Many things are affecting it at any given time, and a law change of some kind would go in there, but it would go in. But it would, it's a process that takes some time. Clearly, the legislative process takes a lot of time, and of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration, constantly. And this will be no different. But right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against, in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
Look, I just think the first question is, how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find, 3 weeks later, the 10-year was 50 basis points lower. So
that's going to happen again.
It's material changes in financial conditions that last, that are persistent, that really matter. And we don't know that about these. What we've seen so far, we're watching it, we're reading, we're doing the decompositions and reading others, but right now, it's not a major factor in how we're thinking about things.
Chris.
He just threw down the gauntlet for the bond market and said, fuck you guys. We're watching it, but we don't see any issues.
Thank you, Chris Rugaber at Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw stock market jump yesterday.
Exactly, Gunnar.
That's renewed some of the questions about why do many cuts at all in this with this backdrop?
To become less constricted.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome.
They've been restrictive. They want to loosen that.
Of course, our mandate is maximum employment and price stability, and we think that even with today's cut, policy is still restrictive.
Yes.
We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal
those
from
bond
its
yields are dropping again,
of 2 years ago, and is now essentially in balance.
They're like, oh, fuck, Papa Powell messing with us.
Albeit at a modest rate.
And
we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its higher,
China.
Its highs of 2 years ago, and we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress, and today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy
That's
stance,
because Powell just threw the
strength in
gauntlet.
the labor market, even as our policy stance enables
We're
further
going back
progress
up, guys.
toward our inflation
We're
goal.
going up more.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path? Thank you.
So we haven't, made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral
10-year
level.
bond yields getting ready to roll
as
over,
a general
guys.
matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but
it's got the highest
something that
interest,
we're just beginning to think about.
Edward.
Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%.
We're going
and it's
up,
been that
guys.
way since
It's gonna be another
July.
killer day.
So why doesn't this data give fuel to a rate pause for this meeting?
This guy's invested in bonds.
So I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But if you look at the 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we also look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low.
If the rest of this conference call continues like this, we're going up. This is really good. He's doing a good job towing the line. He's also telling the bond vigilantes, hey, guys, we don't see a fucking problem. So you can keep doing what you're doing, but we think it's bullshit and we think it won't last. And he's right. He's right. These yields won't climb further. He's got them by the balls.
So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like
must run free.
An example of residual seasonality, so that
yes, Silas.
We saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation?
He's doing a good job.
You see that catch-up inflation also in insurance and several other areas. So you're seeing. We're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be 1 or 2 really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate
10 years
that
just
middle path
dumping,
between
guys,
the two
down
risks.
2.12% on the day.
Hi, Chair Powell. Craig Torres from Bloomberg. Two questions today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question.
Very political question.
I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back.
Employment will have seasonality.
The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment?
Lower yields.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the
yields
election.
Dropping, it means TLT is probably going to go up. Not direct correlation.
This is the great question, and so one we think about all the time.
Bond yields.
I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's come down significantly, moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool, but it seems to be in a good place. And our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market, while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you could say it the other way, that wage increases are now consistent with 2% inflation, given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. We don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Victoria.
They're not getting inflation back to 2%.
Victoria Guida with Politico.
That's a complete fucking lie.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on do you think that
I love that. Good answer,
you're not required to leave?
No.
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data. But in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here, rather than looking backwards. And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong, and you're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down.
Jay Powell is a beast.
Really performing better than any of our global
10-year
peers.
bond yields plummeting, 2.25 now, down
2.25. What I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those, and of course I hear the Reserve Bank presidents do a lot of that, and it's pretty constructive overall. Now, that's not to say there are areas of caution and things like that, but ultimately, overall, pretty positive.
Negative 2.32%, guys.
Follow up the areas of caution. If there were black clouds on the horizon.
No, this doesn't matter at all. He doesn't despise Trump. This guy made it through Trump and Biden, and he's going to make it into Trump's presidency again. Powell is great. And that was an amazing answer. And he's driving down bond yields. They're down negative 2.32% today. On the 10-year. That is a beautiful thing. That's exactly what we want to see. Exactly what we want to see. Dollar dropping too. Awesome. This is all good stuff. He's doing it just the way he needs to do it. This is great.
That you identified as something you're watching, what would they be?
I think it's things like clearly geopolitical risks around the world are elevated.
Yep.
And just as clearly they've had relatively little effect on the U.S. economy. Now, that can change through the price of.
When you've listened to as many Fed people talk as I have, I've listened to all of them, right? Going back to the fucking 80s. I was interested in this stuff a long time ago before I really even understood a lot of what they were saying. He's the most clear, concise, funny, and coolest fucking Fed person I've ever heard.
Of oil or otherwise, but people talk about those as something that's on the horizon.
Yeah, exactly. He put them in
all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year. I've heard this from several people that next year could even be stronger than this year.
I've even went back and watched old videos of them talking.
Hi, it's Andrew Ackerman with the Washington Post. I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors, Greenspan and Volcker, spoke up loudly when they thought large budget deficits endangered economic or financial stability. Will you do that too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable.
Yep.
And we see
Good
that
answer.
you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that we, that to be dealt with. It is ultimately a threat to the economy. Now,
I want to agree real quickly with something Kyle Wright just said. He says Powell has been the only reason we aren't in a huge recession. He's been having to battle terrible policies throughout terrible policies throughout Trump and Biden's. Trump shouldn't have listened to the assholes that were telling him that we needed to close down the economy. If he didn't do that, we would have been much better off and we would have had to do all the money printing. Powell told you guys, oh, don't worry about it. Inflation's fine. It's fine. It's fine. It's fine. And then when he knew he had to flip, he flipped incredibly aggressively to the other side. That fucked a bunch of people up, but it did exactly what he needed it to do. And just like I said before, when everybody's like, oh, he's not going to drop rates, he's not going to drop them, I said, no, he's going to flip on a fucking dime, just like he did before, and he's going to drop 50 bips. And that's exactly what he did. This is a hard job. We shouldn't even have a Fed, in my opinion, okay? But he's done a really great job, and he does a great job managing expectations. I think people give this guy way too much shit. He has had to deal with really horrible shit for the last really for a while, okay? So he's done great, in my mind. He's done way better than anybody else I could imagine.
I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said
psychology
it on many occasions,
is a huge part.
Just said it again.
Okay, thank you.
He did it in 2018. In 2018, he raised rates too. So he tried to. He's tried to do a lot of things over time, and he's learned very quickly. The thing I like about Powell is he fails fast, and then he moves forward, and we need that kind of person in his current position.
Follow up on Victoria's question. Do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
There you go.
Not what?
Not permitted under the law.
Thank you.
Courtney.
You tell him.
Courtney Brown from Axios. In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of...
I just want to say something. You said he did a phenomenal job, started COVID out poorly because of waiting to raise rates. I actually think that was a brilliant chess move. I think in the beginning, he had to wait. He had to wait, and he had to be slow in his position, and then move fast and hard so that he could maintain U.S. dominance in this decision making. And I think he did that. And then I think he had to wait and let other countries fold under the pressure of the U.S. dollar before he eventually caved to lower rates. And then when he did that, he did it aggressively, opening up the tap for everybody else. He's just made it to, he's forced other countries to have to follow our policies. I actually think it's brilliant. I think Powell is 4D chess. He's about as fucking good as it gets. I have huge admiration for him. That's only grown over time. And I've listened to people shit on Powell for so long, but he is a master of this. He's a master of the psychological moves that go in, that are required for a person in his position. He's really good at it, in my opinion.
where those uncertainties are and whether or not it includes some of the proposals that the president-elect has put out on the campaign
trail. He's going to fire Gary
Tariffs,
Gensler.
for instance.
That's happening. No, I was not referring to the new administration's policies at all, nor will I today.
Good job. You tell him.
So what I'm just saying is, as we look ahead, we know, as I mentioned this in my statement, that
negative 2.5% on the 10-year. He's crushing it, guys.
By saying that we think that the economy and we think our policy are both in a very good place.
Yeah, I thought he should have cut then too.
And but as you look forward,
but it all worked out.
You say, what are the risks?
I think he did the right
one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk, and that to avoid that risk, that means you want to move carefully. The other risk is that we move too slowly, and that we allow the labor market to weaken too much and do unnecessary damage to the labor market and to people's working lives. That says don't get behind the curve. So these two things are the two risks that we have to manage, and so we're in the middle there. We try to be in the middle and deal with manage both of those. Again, the idea is to maintain, support the strength we have in the labor market and in the economy, but also with somewhat less restrictive but still restrictive policy, enable further progress toward our 2% inflation goal. This is a thing we're meeting by meeting, we're going to be making our assessment of what the right path is. It's not as important, the precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now to a sense of neutral, a more neutral policy. We don't know exactly where that is. We only know it by its works. We're pretty sure it's below where we are now, but as we move further, there will be more uncertainty about where that is, and we're going to move carefully as this goes on, so that we can increase the chances that we will get it right.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all that longer-term inflation expectations are de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we thought we saw longer-term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing, between surveys and market readings, broadly consistent with, I looked at the 5-year earlier today, and it's probably moved, but it's kind of right where it's been, and also it's pretty close to consistent with 2% PCE inflation. So that's one that's been a traditional one that we look at a lot. But overall, expectations seem to be, and really have throughout this, in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in
breaking out, guys.
2022.
Was real damn close.
Kelly.
Hi, Chair Powell. Kelly O'Grady, CBS News.
Yeah, we got a new all-time high.
We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect
Biddy, break
relief?
it now. Not P. Diddy.
So,
Biddy.
You're right that we say the economy is performing well, and it is.
P. Diddy's done.
But we also know that people are still feeling the effects of high prices, for example. And the world went through a global
this is the last
inflation
question.
shock.
You just finished up.
And inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is it takes some years of real wage gains for people to feel better.
He also recorded a lot.
And that's what we're trying to create. And I think we're well on the road to creating that. Inflation has come way down. The economy is still strong here. Wages are moving up, but at a sustainable level. So it's just, I think what needs to happen is happening, and for the most part has happened. But it'll be some time before people, regain their confidence and feel that. And we don't tell people how to feel about the economy.
Bitcoin,
we completely respect what they're feeling. Those feelings are true. They're accurate. We don't question them. We respect them.
And just a quick follow-up, President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
No.
I'm not going to get into any of the political things here today, but thank you.
Nancy.
Good answer, bro. Come the fuck off.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. What is your plan if we start to see stagflation?
Oh, shut the fuck up. We're so far away from that. So that's stupid question.
The whole plan is not to have stagflation, so we don't have to deal with it. So that
the whole plan is to not let that happen.
It's of course a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate
or
the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market.
She does,
and we believe we can complete the inflation task while also keeping the labor market strong, and that, of course, is exactly what we're
still
trying
short
to do.
Bitcoin?
Can you rule out an interest rate hike next year?
He blocked you?
No, I wouldn't rule anything out or in that far away, but that's certainly not our plan. I mean, our baseline expectation is that we'll continue to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at our that will not change from the September SEP.
Jacklation.
That is our baseline
You guys are
forecast.
great.
And short of some exogenous event, that will continue to be our forecast for the
Dude,
foreseeable
the
future.
10-year is plummeting for yields,
it's-
guys.
We're not in a world where we can afford to rule.
And he's done
rule things
talking. We're
out,
just catching
a
up.
full year in advance. There's
is
just
the
too much
last one, I
uncertainty
think.
in what we do.
Let's go to Jean for the last question.
He won't fire him.
Hi, Chair Powell. Jean Young with MNI Market News.
Powell's doing exactly what he wants,
I wanted to go back to a
lowering
comment that
rates.
you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back on a path to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation goal under the average inflation targeting regime?
Dude, this is
so
totally
people have a
bullish.
chance to catch up?
No, that's not the way our framework works. We're aiming for inflation at 2%. We did not think it would be appropriate to deliberately
He is
undershoot.
lying about that.
And
Just so you
part
know.
of the problem there is that low inflation
That is not what's
can be
happening.
a problem too, in a way. But that's not part of our framework, and it's not something we're going to be looking at in our framework.
Yeah,
review.
exactly, Kavita.
Thank you very much.
Okay. So that was great. Yeah, so there's no need to fire him because he's coming in while he's being dovish. He already dropped rates 50. He's going to drop another. He dropped 25 today. He's going to drop another 25 in December. Maybe we pause in January. I don't know. We'll see. But right now, guys, if you look in the bottom corner and you look at this 10-year, it tells you all you need to know. It popped up to here to 4.37, and now it's getting absolutely crushed, about 5% down from the peak of that conversation. Papa Powell told the bond vigilantes that they can. Well, I shouldn't say that they can make other choices. let's be PC here. That they can that they're going to lose. He told them they're going to lose, and they realize that they should probably buy some bonds while they get it at this good rate and try and lock some of it in. Because if you look over here, I mean, just look at this, guys. Think about the bond yields here. Let's just go back a little bit. And I'm going to flip this to the main screen just so we have a better view. So, that's a little weird. Let me do this. All right, so let's just look at this, guys. Look at what happened. So bond yields on the 10-year on September 16th were only 3.6%. And then they climbed all the way up to 4.47. Why the fuck wouldn't you lock in there? If you wanted to get some easy income, why wouldn't you lock in at 4.47% when we were down at 3.6, when you can get 1.1% extra yield for 10 years? You'd lock that in, right? So I've said this before, and this is one of the reasons I put this little line up here. This is the rejection point. And this is a beautiful rejection. It's called the tweezer top. It's exactly what you want to see on this daily candle. Huge skyrocket, huge drop. This is beautiful. This is beautiful. I couldn't ask for better here, okay? Bitcoin pushing 77,000, new all-time high right now. Okay? Everything that just happened in this call was delicious. Okay? Oh, Papa Powell. Love you, brother. Rocket Holdings and McDonald's. Kevin is just retarded on some things, man. He's really a brilliant guy, but he just needs to slow down and learn what he's doing. And maybe like in 5 years, Kevin will just be brilliant and way better than I am. I don't know. But he's not there now. Would you swap Ethereum for Bitcoin? I wouldn't personally, but I wouldn't personally, not myself. I would actually bet on Solana instead. I'd bet on Solana. Here's why, guys. Let me show you. Sorry, I clicked this other thing and it screwed up my chart. Here's why I bet on Solana. I show this every once in a while. A, it's got way more transaction volume. B, this is by market cap size that we're looking at this. So Ethereum has been really punished. So I said, hey, it's going to outperform. And yes, it's doing that. But look at the market size of this. The market cap of Ethereum is $349 billion. The market cap of Solana is 93. So it is like 1/4 the size of Ethereum, but it's got way more development as of late, way more transactions, DEX volumes, everything is happening on Solana because it's just a simpler solution. And Ethereum is not Bitcoin. It was never designed to be Bitcoin. So do I think Ethereum's going away? No. Do I have bets on layer 2 solutions for Ethereum? Yes, a bunch of them, right? I've got Arbitrum and Optimism and a bunch of isms. So I still think that you can make a lot of money with these smaller ones because, again, Optimism's a layer 2 solution on it. And look how tiny it is. It's 2 billion versus 93 of Solana's network, or the 350 billion or whatever of Ethereum. So I like the small ones. I like the small layer 2s like Arbitrum. Arbitrum, I think, is a layer 2 on it. Yeah, whatever. I can't even remember anymore. But 2.32 billion, nice little tiny play that could take off a lot if Ethereum does well. So I'd rather put smaller allocations to the layer 2s on Ethereum and the opportunity that they might drastically outperform and become like the major layer 2 on the Ethereum network. And I would have much greater upside potential, and then also bet on Solana. That's my take, okay? Render's a good one. Yeah, Render might be great. There's a lot of wonderful people in that company, guys. Like, super impressed with the number of people and then the quality of people that are in that. So if you're going to get a shitcoin, Render might not be bad either. Jesse, would love your opinion on DXYZ. Is that a shitcoin or is that a stock? You guys got to clarify here. All right, let me just real quick here though. I don't know if I'm going to go into a big thing where we're looking at a bunch of stocks. I just want to watch the magic of breaking $77,000 right now. Okay, I just want to sit back and watch this while we watch the 10-year rollover. Okay, we're going to watch the 10-year rollover. Is this the 10-year? That's the 2-year. Where's the 10-year? 10-year. That's the inversion. Where's the 10? Oh, yeah, I put it up here. Let me grab it. Oh, yeah. Let's bring you down. Bringing you downtown. All right, here we go. 10-year. So the 10-year is down 2.6%. Remember, what did we say earlier, guys? Somebody brought this up in chat. They said, hey, Jesse, do you agree that the 10-year is the greatest reflection of what is going to happen with mortgage rates? And my answer is yes, I think that is true. And what has it done? It went from a peak today of 4.5 down to 4.32, and it's getting ready to roll the fuck over and drop like a rock, in my opinion. So again, I've said this for a while, but I do believe that we're going to see interest rates coming down for mortgages heading into the spring. So over the winter, we'll start to see this, meander a little bit, top out, roll down. I think it's going to even start now, honestly, after this meeting with Papa Powell. And I think we'll continue to see rates coming down. That will bleed into the spring where we start to see existing inventory come in for homes. And between the existing inventory increasing and prices coming down for homes and rates coming down for homes, you're going to see the housing market fucking explode because existing home sales are at some of their lowest levels in history, going back to the 90s. Okay? They're at the bottom of the great financial crisis, which was stemmed from people owning too many houses that they couldn't afford at rates they couldn't afford them at because they got a bunch of adjustable rate bullshit. So we're at the bottom in housing, guys. We're at the bottom. Sui's useful? Yeah, maybe. I've got it. I don't know. I just got a bunch of shit coins. Thank you, John, for the $2 tip. And thank you, Dan Margot, for the $2 tip. I appreciate you guys. Mucho says, James believes layer 2s are band-aids and cannibalize the layer 1 chain. Stick to Solana as his premise. I agree with that. But I do think that the cannibalization of the main chain can benefit some of the layer 2s. And I believe in diversification. I do agree, though, that Solana is a great bet. It is my largest position out of my shitcoins. I don't own a lot of Ethereum at all. Most of my extra money is, again, in stupid shit like Doge, Bonk, and a bunch of layer 2 crap on Ethereum. And maybe some like Cosmos and other stuff. Let me see. I think I have this somewhere. I can show you guys some of this. Yeah, this is, yeah. So here's a lot of my shit coins, right? So you can see 151,000 in Solana. That's a pretty big amount. I've got it staked and making interest on it. Near Protocols one, Ethereum, I've got a little bit, Optimism, Bonk, Arbitrum, Render. I don't own enough Render probably, even though I do have this on a different account too. And then Injective is another layer 2. I want to say Polygon, Cosmos, Stacks, Dogecoin. I just got a bunch of bullshit in here too. But again, I don't care about shitcoins. Wow, you guys are awesome. Thank you. What am I missing here? Wagabond, thank you for the $2 tip. Mr. Casper, thank you for the 20 memberships. That's incredibly generous. I appreciate it, sir. But yeah, so hopefully this is all good, guys. I think this was a really great Fed meeting. I couldn't be happier about it. The market is just ready to skyrocket, in my opinion. It looks like Bitcoin did hit a new all-time high of 77,000. It broke it, and then it retraced a little bit. This is normal. This is not bearish. This is not bearish. Let's see what we are. What are we at for the daily? How high are we on the RSI? I haven't looked in a while. Let me see if I can find. So we are in overbought territory, but just barely. And if we go back here, guys, we gotta look at some stuff, okay? So if we go back here, let's focus on the RSI, okay? Let's just jump into here. So let's look at previous really high levels on the daily. Just going back to 2023 and 2024. The 90s and upper 80s are when we're really overbought on Bitcoin on the daily time frame, okay? That's the really, really overbought zone. We're at 71. So I care a lot more about Bitcoin when it hits 80. I'm going to set a marker right up here, okay? The second we cross over into 80, we're going to know it, because I want to keep an eye on that. But for now, this is nothing. We're going to 92,000. I keep saying that, and each time I have to raise this little bar because we're further up. Okay? I said this was coming. This is what happens. This is just it. It's just a normal part of the process. But there's a lot of money to be made. A lot of money to be made. It's happening. Don't forget to hit the like. Yeah, if you would do that, that's great. 20% move, guys. This 20% move could get you 100% in your miners. I just want you to understand that. Because they benefit later, okay? They benefit later. So it's going to get real fucking weird soon. I hope you guys understand this. It's going to get real weird. And we could have also some other things that you guys probably need to understand. Over 20% of the stock buybacks occur in the last 2 months of the year. Okay, about $6 billion a day is going into buybacks in the stock market right now. So you need to keep that in mind too, and that number grows every year, so it could even be a little bit larger. So we've got the election tailwind with Bitcoin. If you guys go back and look at what happens to Bitcoin after the election, it's vertical. It's vertical. It's up every time. Why would it be less this time? We literally have the greatest change in political history that's probably ever happened in this country. We've got the highest popular vote for the Republican president, Donald Trump, in 20 years. We've got, I forget how far back it goes, only one other time in history, I believe, if I'm correct here, have we seen a president come back for another term after being out of office. We've got global liquidity still set to just rocket. We've got China just folding right now. Just folding. Thanks, Banu, for the $5 tip. I appreciate you, sir. And while they fold, and while we apply more tariffs on them, and while we put more pressure on them, they will have to print more and more and more, flooding the markets, pushing, and then capital will fly out of the country, just like it has been, going into other countries around it, into Bitcoin, and into the United States, because this is the place to invest in right now. If you don't understand that truth, you are going to miss out, okay? And our bond market is going to fucking come back too. This is great. This is so great. I hope you guys can understand that. MSTU is 18% again. What? I mean, that makes sense. Let's look real quick. What's the watch list look like? We'll do this real quick before we ignore the BIT Oh, good, they fixed it. So MSTU is 15% today, guys. I might shave off a hair of this. I don't even know how much I have. I don't have a lot. Let's see here. I mean, I got a decent amount. I think I got 50, 60,000 in MSTU. It's a decent amount. I wish I would have added more, but whatever. But that's cool. I'll probably leave it. Fuck it. BITX, don't have a lot of that. Everything's doing pretty good today, guys. It's not a bad day. by any means. What am I using for charts? TradingView, only TradingView. And for TradingView, if you guys want to buy TradingView, to be able to use it and kind of do your own thing, wait until Black Friday. They give like 50 to 70% off. I'll get a discount code from them, and you guys can benefit from it, okay? So Jake, there's a few of us that do this kind of stuff on X where TradingView reaches out to us and says, hey, can you promote this? And we will. But that's the time to do it. Black Friday is the time to do it, and that's only a couple weeks away. U.S. is number one potential upcoming. Dude, we are the place to be invested in. That's why ARGT was down today. That's why ARGT is down 2.24%. I actually think the Argentinian fund is going to be a great investment opportunity in the future. But who wants to invest in Argentina right now when they've got a sure bet with the fucking United States? A sure bet. Literally the perfect storm to invest in the United States of America. Hey, Jesse, why do you think Mara is lagging that hard and to compare to other miners? I hate that question. I don't care. But here's the thing. We talked about this earlier. Mara has the highest level of short percentage against it. So it's receiving a lot of short pressure. But what's going to happen when that breaks? What's going to happen when that breaks? Right now, the short percentage is 27%. What's going to happen when that breaks? It's going to be a dam coming through. So I don't know. I'm not really worried about Mara personally. I think I've got at least 100,000 in it. I'm not 100% sure. But I actually, am at Mara? Yeah, Mara. I think I've got like 100,000 in it. But it's gonna be crazy, right? When you got almost 30% short interest, when this thing does start to rise, it will be insane. It'll be insane. They'll crush them. And you got to remember, this is the largest publicly traded miner outside of MicroStrategy. If we ignore the synthetic minorness of MicroStrategy, it is the largest holder of Bitcoin from a publicly traded company by a large margin. So I think it'll go up a lot. Yeah, it's going to just screw people. It's going to screw the shorts. Soaring Shitty, maybe because earnings are coming next Tuesday. Yeah, that's possible. Hey, earnings probably are not going to be great over the short term. So that's possible. I agree with that. All right, what time is it? 2:30? Let me check real quick. I want to see. I'm almost curious what these guys are going to say afterwards. Any insight into Tesla? Yes, it's the greatest fucking company on earth. That's my insight.
Well, that was Fed Chair Powell following the decision to cut interest rates by 25 basis points. The chair saying the economy continues to expand at a solid pace, that labor
Lucid's
market
Gravity
conditions
SUV online
have
configurator
eased.
is now live. A fully loaded
on
Gravity
rate
Grand
cut in
Touring is
December. I want to show you what the
$125,000.
major averages are doing, pretty much hanging on to those gains.
company's
It
dead.
does follow that massive day. Yesterday, NASDAQ's been the outlier all day, up 1.5%, but the S&P and the Dow are also winners. Welcome to Closing Bell. I'm Scott Walker, live here, Post 9, New York Stock Exchange.
I hate this
Let's
guy.
bring in now Double Line Capital CEO and CIO Jeffrey Gundlach. Jeffrey, welcome back for our traditional visit.
The interviewer.
Hey, Judge. Good to be here again.
It's good to have you. So what is your reaction to what the Fed chair had to say today? He used
Let's see what the experts have to say.
words, the one we talked about last time, recalibration, and then remarkable, he said, when describing the resiliency of this economy.
Love it.
Yeah, recalibration showed up again, and that's a repeat of the last meeting's sort of word of the meeting. And I think Powell feels very much that he's in a good place now.
Yep.
Because since the July 31st meeting, we have the 2-year Treasury rate is up by almost 60 basis points, and the Fed funds rate is now down by 75 basis points. So he's gotten much more in sync with the bond market by a movement of Fed funds relative to 2 years of 135 basis points of convergence in just basically 2 meetings. So I really think that we probably have one more rate cut coming in December, because that would true up the Fed funds rate with exactly where the 2-year Treasury rate is right now. So it is interesting that we've had such a strong performance of the stock market since the last Fed meeting, while we've had interest rates rising. So you've had a tremendous outperformance of stocks versus at least.
All right, one sec. I do want to hear the rest of what Gundlach has to say. Mr. Casper said, and somebody was talking about this earlier too, so I just want to kind of hit it. Mr. Casper, Jesse, if Elon gets the role of Doge, he's got it. And cut spending isn't that kind of like tightening and less printing. No, that's the narrative, Mr. Casper. I'm glad you brought this up. The narrative is, oh my God, I'm so scared. Thank you for the super chat, Christopher. Appreciate that. The narrative right now is, oh my God, dude, Elon said that he made a comment that it could be painful if with the cuts they're doing. Yeah, he did make that comment, but it was also completely fucking taken out of context. Here's the reality of what he's talking about doing. He's going to fire 80% of the federal government. 80%. He hasn't given that number, but he has. You know why he has? Because he did a bunch of posts talking about how there are 430 fucking government agencies, and then in an interview he said there should be less than 100. So if you do the quick math on that, that's not looking very good for a lot of people that work for the government. Now, here's the caveat that is the most important of all. When he fires all these dipshits and reduces the size of government by 75 to 80% and gives the power back to we the people, he's going to give them 2 years of pay and then let them re-enter the private market or retire. So you know what that does? It lets everybody know that we're going to have a more sustainable future and that costs are going to come down in the future across the federal government, which makes people invest in our bonds because they're like, oh, the yield is really good. And so they start buying our bonds back, buying TLT. They start going, wow, the USA is going to be okay. And then at the same time, we don't see the spending go down because he's not actually taking away their pay for 2 years, but he's letting people know, hey, it's spending is going to get a lot better in the next 2 years when we go to elect people again. So you have this benefit of, oh, hey, we should start buying bonds now because we trust the government and the path that they're taking because it's going to be smaller in the future and we can see that. But then at the same fucking time, people still have all their spending power. In fact, they have more. Why? Because we're going to take away taxes on Social Security so that the poor people that have been screwed by the inflation actually get some of their buying power back, which is a large number. And then also, we're going to not tax tips so that people that are at the poorer end of the spectrum have more money for spending. And then we're going to maintain our corporate tax credits. And then we're going to put on more corporate tax credits for people that bring manufacturing back to the United States. We've got the most pro-growth policies possible right now at a time where we're going to reduce government debt and spending. But it's all good because we have the most brilliant fucking minds on the planet making these decisions right now. Elon Musk has the right, or I should say, Donald Trump has the right fucking people working for him this time. When he originally went into office, he just said, who should I hire? And everybody told him who to hire. Now, he literally has some of the most brilliant people on the planet that are going to be working with him. If you don't understand how big that is, I feel bad for you. You should figure it out. A lot of the FDA people, the FCC, the FDA, the SEC, all of it is getting torn up. All of it. The FTC, every effing one of them. Play on words. This is a big deal, guys. What's happening right now is a really, really big deal. I hope I'm emphasizing it enough.
Treasury bonds since the last Fed meeting, and I attribute that basically to the election result. So we had an incredibly consequential election result.
Yes.
Very different than a lot of people probably were forecasting as a base case a few months back.
Yes.
And we've had one of the least consequential Fed meetings today with basically a repetition of this idea that the goals are normalizing, the labor market's normalizing, the quits rate and the job openings rates are kind of where they were pre-pandemic. And so I think the Fed is feeling very much that they are plodding along towards their goals, and he said so in fairly direct language today.
Yes.
So yeah, the thing that's sort of surprising me a little bit is...
I hate to interrupt Gunlock because he's a really smart guy, but I do want to say this. Alex Garcia said, is there any chance they cut taxes for capital gains in the future because IRS is going to crush me this year? Yes. Yes, I think especially for long term. I think you could see either them increase the threshold for capital gains tax to a higher amount to lower the tax obligations with that, because you want to encourage spending. You want people to get rich and have more money. You don't want too much of that, because if you get too much for the upper ends, then you have a problem where you could further ignite inflation because you have all this spending and demand increases and yada, 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 right? But yes, I could see them doing that. I could see capital gains getting better. At the very least, though, if capital gains stay the way they are, as long as you're doing long term, you're in a great place. Hey, guys, for you guys not in the U.S., do you think long-term capital gains of like getting 15% on your investments for tax is a good deal or not? Do you guys think that? How much do you guys pay in Europe for capital gains taxes? When you sell an investment, how much do you guys pay? Can you tell me? Tell me that compared to what we have here in the States where you can get 15%. Let me just show you guys a calculator here in the United States if I can find it. Yeah, right around here. Okay. So here, capital gains tax for 2025, okay? Here's what we have. So married and filing jointly. If you make, this is insane, guys. This is what saved me, okay? This is what made it to where I could live off of my gains. Because if you make, without an income, I didn't have an income, less than $96,700 in taxes, or I should say an income from capital gains. It's not income, so let me just take that back. Capital gains, then, and I made this in my IRA, right? There were years where I made $90,000 in capital gains. I sold it. You know what my tax rate was? 10% because of the early withdrawal penalty. 10%. But if I didn't have an income, my tax on almost $100,000 would be zero. Zero. And this is 2025. It was a little bit higher for 2024. Whatever. But look over here. The first 100,000 is basically 0%. Okay. And then after that, if you don't have any income, and then after that, married filing jointly, your capital gains is for 96 to 600,000 is only 15%. You don't go up to 20% until you've made more than $600,000 married filing jointly. These are some of the best investment numbers on the planet. Okay? Yeah, Netherlands 5.7%. That's if I'm not wrong. Yeah, I don't know if you are or not. I can't speak to the Netherlands, but look at Germany, 26%, Finland 30, Denmark 35. Turkey sounds good at 10%. That's great. But see, with economies that aren't doing as well, that aren't as old, they give you better deals, right? They give you better deals. Canada, 50% gains at our current rate. 50%, guys. What the actual fuck? Leave it to the Swiss to be at zero. That would make sense. But you can see where, again, we have room to go down, but we're also a really great place to be. Because paying 0% for your first $100,000 on capital gains, that's how you stay retired after you get enough money. Because if you don't have income, your tax rate plummets. Just think about this, guys. If I withdrew if it wasn't from an IRA and it was long-term capital gains, and I withdrew $200,000 for 1 year in 2025, I would be paying an effective tax rate of 7.5%. Way better than income tax. Very, very sustainable amount of money too, right? And think about this. If you make $200,000 a year between like you and your wife, your tax rate is much, much higher. So you actually have way less spending power than me cashing out $200,000 with something without a tax penalty and only paying 7.5%. Because if you're paying 30% on your income tax, that's a way worse number, and you have a way less power than me making $200,000 in capital gains and getting taxed at 7.5%. Okay? It's pretty good stuff. We live in a great country here in the United States, and I do see this maybe even getting better. We should all be excited about that. My understanding is if you don't pay any taxes on the first 48,000, then 15% on the next 553, then 20% on the... No, not in the States, dude. That's wrong. Well, I mean, it depends if you're talking about single or joint, right? So if you look down here for 2025, you'll see that if you're single, it's 0% on the first 48,350. And this is for 2025. If you're looking at 2024, it's up here, right? So it's 0% for the first 47,000. Then after the 47,000, let's say you made 100,000, then you get 15% on the 47,000 and up. So you would pay, in effect, if you cashed out $100,000 as a single person in capital gains with no income at all, you're only paying 7.5%. Pretty good number. Any thoughts on Canadian housing bottom, capital gains? I don't know Canada's market well enough. I know there's a bunch of foreigners buying it. I know there's a bunch of Chinese that buy in Canada. I know you guys have really unaffordable housing, like ridiculously unaffordable. But I can't speak much more beyond that. I just don't know. And I know you guys have, in Canada, don't you guys have like 100-year mortgages? Am I wrong? Is there a 100-year mortgage in Canada? Can you guys tell me that? Let me look here. Canadian mortgage terms. Only 30 years? No, man, I thought there was something more than that. Maybe I'm confusing you with a different country. Maybe. Let me look. Max is 30 in Canada? All right, maybe that's true. Why did I think there was 100? 100-year mortgage. I know the 100-year Japanese residential mortgage. Are there 100 years in Japan? Is that what I'm confusing it with? Maybe I am. A recent innovation in the Japanese real estate industry is to promote home ownership with 100-year mortgage terms. 100 years. That's insane. So maybe it's not Canada. Is there a 50-year mortgage in some of these? 50-year mortgage. Which countries? One sec here. Which countries have a 50-year mortgage rate? Japan has a 100-year mortgage and has for some time. The UK has between 30 and 35 years. It says a new UK lender, Perina, is set to offer 30 to 50-year mortgages. Korea has 50-year maturity mortgage loans in July of 2023. So we're flipping to 50s, guys. Oh, do you guys have a lot of adjustable rate mortgages? Maybe that's what I'm thinking of for Canada. You guys are on a bunch of ARM bullshit, which is stupid. Australia is too. It's really bad. Let's see how markets are doing. So Bitcoin doing all right. Nothing crazy. Let's see how the rest of the market's doing. What's Tesla up to? Tesla down. Oh, no, that's the total. That's the total market cap. Let's look over here. Let's do by change percentage. So MSTU's come down a little bit. Ethereum is up 6.67 for the fund, 6% for ETH. I think that came down a little bit too. Solana's up 5.5%. Bitfarm's up 5%. CleanSpark is up 4.5%. Tesla's up 3.26%. It looks like the market maybe just retraced a little bit, but I think this is all bullish. I think we're still going up, guys. I think we're going up. I think everything we just heard today is bullish. In Sweden, it's no amortization if your loan below 50% market value. Okay. Matt, that $650 would look nice for Tesla. $659. Not sure what you mean by that. Not 100 years, but first-time buyers can borrow up to $2 million. Talk about getting railroaded. That's crazy. A first-time home buyer in Canada can buy a $2 million house. There's got to be income requirements on that. How could you get a $2 million first time? That's a balloon mortgage here in the U.S. That's crazy. Kyle Wright, will having an LLC decrease your tax burden? No, I don't think so. Maybe. It depends on the tax. I got to do a bunch of research into it. The LLC for me is just limiting my liability. People are weird. Even though I have disclaimers all over the place talking about how this is not financial advice, I don't want people coming after my own personal assets because they do some stupid shit and misread a post. You know what I mean? So that's the LLC. The LLC for me, and there might be additional benefits because I might hire my nephew eventually in the future. There's a lot of other stuff that where I could maybe get a reduced tax obligation because I'm using it as a business instead. So potentially, let's just say potentially. All right, guys, I think I'm bored. I think we got a lot of the good stuff here. We talked about a lot. It looks like I'm up still over $200,000 on the day. I have no complaints. That's almost 1.1 million in 48 hours. So I have no complaints. Very happy with everything right now. Canada is the CCP. Yeah, sadly, right? The CCCP, is that a play on words? One extra C. If you guys can get Trudeau out of there. Stanley Druckenmiller had a recent interview on CNBC. Is it CNBC? If so, dude, let me know. You know what? I got to let Gundlach finish here, too. I want to hear him, actually. If that's on CNBC, though, let me know. Oh, it's not? I'll see if I can find it. I want to hear Gundlach talk, though. Let's finish this.
So willing to dismiss the softening jobs market. I mean, the 12,000 jobs, I know people want to attribute that to one-off hurricanes and strikes and stuff like that.
The job market sucks outside of government.
But I keep looking at the household survey, and the household survey over the last 11 months has been a loss of jobs of over 300,000 jobs cumulatively over the last 11 months.
He's not lying.
And so that typically is a little bit more real time at economic turning points. It's still not terrible, the household survey. It's very volatile, so we have to watch out for that. But it is not showing tremendous signs of strength. And the real problem that the bond market seems to be having, from my perspective, and it's being talked about much more in the open, it came up several times at the press conference today, is that the supply of Treasury bonds is getting to be rather astonishing. We have a $2 trillion deficit. It's about 6% of GDP over the last 12 months, and we still have a growing economy. And the interest expense on the debt, which I always talk about, 3 years ago was $300 billion per year. It's now $1.3 trillion per year. And we have a great volume of bonds that are rolling off with very low interest rates from 5 years ago or even 3 years ago. They are being refinanced at substantially higher rate levels. And this is going to continue to be a supply problem for the bond market. And for this reason, we are not positive on long-term Treasury bonds. In spite of the fact that the economy is sort of gradually slowing down, it's just the supply of bonds is very troubling. And so we recommend investors stay at the intermediate part of the Treasury bond market and not out in the 20 and 30-year bond sector. In fact, when we were at the low in rates, basically several weeks ago, we made another duration cut or maturity cut in many of our bond funds because we do not want to be exposed to this fiscal financing problem, which I think could very well lead to rising interest rates in spite of the fact that we might have a slowing economy. So interest rates are rising. We have
he's afraid of stagflation. I disagree with this totally because I don't think what people like this are, why people like Gundlach aren't seeing. Here's what they're not seeing. I agree with him about all the problems that exist. I totally agree that the job market is weaker than it appears. I think that the government is making up for a lot of that. All that stuff is true, right? Like all that stuff is true. But he's not accounting for the fact of what Doge is going to do in this government and how much power Trump is going to give Elon Musk in order to be able to reduce the cost of government going forward. And the markets are forward looking. All the stuff he's saying right now is true, but they're looking for what's coming next. And if they get optimistic about what Donald Trump and Elon Musk are going to be able to do for this economy, then that's where the markets go. So I will look at that Druckenmiller interview. It's a long one, but yeah, it's a day ago. I definitely want to hear Stan talk. I love Stanley Druckenmiller. I think he's really smart. I think Gundlach's smart too. I just disagree with him right now. And again, he's telling people to stay away from the long end of the curve, right? He's telling people to stay away from the 10, 20 year, or I don't know if he's saying 10. That's probably like, that's probably long end. That's probably long end. 10 to 30 is probably the long end. So 10, 20s, and 30s because he's worried about the government's ability to repay in the long term. So that's fine. I get that, but that's changing, and that's why I'm going to be buying these as cash because I think the downside risk in TLT is a lot lower than the upside potential in it, okay? And again, if the bond markets got back to where they should be, and I don't know if this happens for a long time, but I do think that the mid-level is a good number, right? I think the mid-level we could do. If we got back to like, I mean, look at this. The monthly is already just all these averages are underneath of us and this thing's ready to go higher. But if we look at the monthly on TLT, just look at how badly this market has been crushed. We are literally at levels the bond market was at in 2002, 22 years ago. 22 years ago. And you get dividends for this shit, right? You get paid out. So it's insane that you're getting these for this cheap. The only reason you're getting them for this cheap is because people think that the markets are fucked, like, or the government, I should say, is fucked, and it's not anymore. It would have been if it was Kamala Harris. I would not even be talking about TLT if it was Kamala Harris. But I do love the 32% upside in my cash position that I'm going to be growing. Just over a very short period of time, this thing could go up 32%. Plus, you're getting paid out in dividends, yo. So, like, what's not to love there? As long as you believe that the U.S. government is going to get leaner and meaner and better than it's been for a very long time, like I do, then bonds look attractive on the long end. But if you don't believe in the federal government and you think that the federal government is going to be destroyed and you're just always bearish on the U.S. and you think the only way that things are ever going to be okay is with Bitcoin, like some maxi who gave up on the USA a long time ago, then don't buy bonds. Like Finance TG is talking about. But I think that's stupid. I actually think that's a stupid take. I think that's an ignorant take. I think that's a take that people have been saying for a long time. I think the bond market in the U.S. is still going to be okay. I do love Bitcoin. I think it's an amazing play. I think MicroStrategy is a great way to get yield off of the Bitcoin play. I agree with all those things. But I think it is ignorant to believe that the U.S. is failing right now with the direction we're looking to go in. I think that's a stupid take. But I do think that Bitcoin benefits when all the other countries fall apart. And there's definitely a few that are going to be on the list. And if you're not a democracy and you don't believe in capitalism and meritocracy, you're going to be on that list. Betting against the U.S. economy is a horrible idea. Warren Buffett would tell you that. But again, you can agree on a lot of different things and disagree on some, right? I think Bitcoin's an amazing investment. I think Tesla's an amazing investment. Just like you said, why would you bet against America when we have Elon Musk, when we have Tesla, when we have AI, when we have robotics that is coming up, when we have probably one of the greatest time frames in history to be alive right now in regard to opportunity to make money? Why would you bet against it? Why would you bet against that, especially if we make leaner and meaner government? Why would you bet against that? That's just a stupid take. So, not saying you're stupid. I'm just saying that there's consensus ideas that need to be reformed, okay? You need to reform your ideas based upon new information. If Kamala Harris was in government, there's no way you should buy U.S. bonds. No way. But it's not her, okay? There's a new guy in town. His name's Donald Trump. Anyway, probably going to let it go there. On that note, though, so since we love our bonds so much right now, or at least I do, we're going to throw out a song I make you guys suffer through over and over and over again if I can find it. Where is it? We got a bunch of Elon. God, there's so many songs. Why is there so many songs? Let me see if I can find the one I'm looking for. We're going to go out in this. If you guys have anything else you want to add, please throw it out there. Oh, hey, guys, I guess also, just so you know, Trump might not be a felon anymore. It looks like they might roll all that shit back. Isn't that funny? Isn't that funny? All right, the America First one. This is the one I want. The old will be new again. Yeah, guys, we've unburdened ourselves from what has been, and now we're going to be reborn. So don't bet against America. I think if you do that, it's at your own folly. I really believe that. And I'm not just saying that because I live here. That obviously gives me a bias, but I don't bet against America right now. You're betting on the fact that the monetary system is broken. Why? Why can't it be fixed? If we embrace Bitcoin Finance TG, why can't it be fixed? We're talking about a Bitcoin reserve. We're looking at Cynthia Loomis talking about trying to get to 1 million Bitcoin for U.S. holdings in the next 5 years. We're talking about we're still the world reserve currency, and we're talking about potentially reducing the size of government by 75 to 80%. So I get that is the prevailing thesis amongst Bitcoin maxis, but I'm not your average guy who follows the herd. I think that's the wrong way to be, and I'm telling you what the future is, and I've got a pretty high success rate of telling people where the future is. So better investments. That's going to be right for a period of time, but they're cyclical, finance. They're cyclical. So at the end of 2025, Bitcoin will not be your best investment. MicroStrategy sure as fuck won't. That's my thesis. Unless you're saying that this time is different and we've reached a time where Bitcoin and MicroStrategy will never go down again. And I honestly don't think that's true. I think everything has a cycle. Everything has a status of overbought and oversold. And that's the way you should look at it. Anyway, the bell has closed. I am done for the day. I love you guys. We'll see who ends up being right about this. But for now, I'm rocking and rolling with this orange-haired motherfucker right here. Peace out, guys. I love you. Bye.
I got love for every nation. I got love for all races. I got love for all religions. Got love for so many places. No love for a politician, a congressman, or a senator. If the country that they put in first ain't the United States of America. No love for these politicians with corporate interests in other countries. Only one that I serve is God. I don't serve man, I don't serve money. No love for the people living in the USA, but always hating it. Got a lot I probably shouldn't say to y'all. Matter of fact, I'll just pray on it. I'm pro-life, pro-God, pro-gun, not ashamed of it. Yo, worshiping bullets, yo, killing babies, mutilating children, yelling Satanists. Supporting the troops in their tour doesn't mean that you're supporting the war. Supporting the freedoms that they fighting for doesn't mean that you're supporting the gore. Supporting the country I live in and loving it doesn't mean blindly supporting the government. The world that we live in is trouble. They turn off the media. We should defund it. Supporting America for other nations does not make me a racist. If you like communism so much, I'll pay for your vacation. America first, the people are hurt. Got vets in the street with nothing to eat and nowhere to work. Sending our dollars overseas and funding these wars. No love for these politicians if they're not America first. America first. This countries protect their borders. It's not a controversial subject. I say cause the southern border, it seems to get people upset. I don't care what names you call me. We in $40 trillion of debt. Uncle Sam takes half your money, then you get a little refund check. I am America first. Kamala cares a better purse. I never sell out the people to raise my net worth. The Second Amendment is there to always protect my first. I'm a better rapper than Meg Thee Stallion, and I don't even have to curse. Let's keep the American dream alive and put an end to all the lies. BLM raised billions, and what did they do for black lives? Politicians promise you the whole world, then they backslide. What happened to Hunter's laptop? You know I'm most strapped up. Gun rights are human rights. Feminists been sold a lie. You can mess around and find out. Play stupid games with a stupid prize. God bless the whole USA, even the ones you hate me. Still fighting for you today, and no globalists paid me. America first, the people are hurt. Got vets in the street with nothing to eat and nowhere to work. Sending our dollars overseas and funding these wars. No love for these politicians if they're not America first. America first.